So today I want to tell you the secret to having a successful career fair, and I've got several points here I want to walk through. First of all, apparel. What should you be wearing to the career fair?
Professional.
Professional. What's professional mean?
Suit and tie.
Suit and tie. So, finance. What should the shoes look like? You guys know that there's a difference between, so in finance, for some reason, lace-up shoes, you won't see tasseled loafers. I don't know why. It's just one of those things that you watch and you see. That's what I would wear if I were you. Now, if tasseled loafers are the only things that you have, as long as they're shiny and clean, it's still cool. Your top button on your shirt, buttoned or unbuttoned? Buttoned. Your tie, and I checked mine before I came in here to make sure it was up high enough. If you have your top button unbuttoned and your tie loose, you don't look casual, you look like an alcoholic. So don't do that. I had a guy tell me in a teaching evaluation, he's like, well, I work for a Fortune 500 company and I never have to wear a tie. I'm like, well, good for you. But for those of us that are in finance and are working in that area, you need to wear your tie. Let's see. Oh, shirts. Shirts should not be wrinkled. And in fact, how do you get a shirt to not be wrinkled? Does anyone know? Iron it. Now, how do you keep it not looking wrinkled? Starch. Now, I am lousy with an iron, and I am worse with starch. And my wife is even more disabled than I am in those varieties. So, what do? You take your shirt to the cleaner, and you get them to launder it and starch it. It doesn't cost that much, and you can look really crisp all day in a good starched shirt. What's better, an expensive suit that doesn't fit you or a cheap suit that fits you well? Yeah, a cheap suit that fits you well. So if you need to get some alterations made, you can go out and do that. Let's talk about grooming. Should you brush your teeth? These are basic things, but I run into students at the career fair sometimes and I'm mortified about what I see. Okay, so you should have your hair combed. You should be either clean shaven or your beard neatly trimmed. You're looking a little sketchy there. Right? So you either need to grow that out or shave it off. So you should look neat, right? Your handshake. There are a couple of things about the handshake that are important. Can someone describe to me what a good handshake is like? Captain Barrentine.
It's strong but not obnoxiously, like you're not squeezing too hard, but you don't want to seem weak.
Yes, firm but not bone crushing. Just drives me nuts, especially these ex-football player nut jobs that are wearing their championship ring from 1977, and they want to crush your hand. That's bad. Now, what's the other bad kind of firmness on a handshake?
It's really weak.
Yeah, we call it the limp fish or the dead fish. Don't do that. Now, what about temperature?
Just try to dry your hand off if you're sweating.
That's going to be my next point. So if you've got that kind of a problem, just have a paper towel in your pocket. Kind of soak the sweat off of it before you offer your hand up to someone. Just make sure you don't pull the towel out when you pull your hand out. I have something called Raynaud's phenomenon, which means that my hands are basically almost always cold. When I was a little kid, my grandma would shake my hand and she would say, well, you're just as cold as death. Grandma died in 2008. Who's cold now, Grandma? Too soon? Okay, so, now here's the problem. A lot of people interpret that. They don't say, oh, what, this poor guy has a problem. They think, well, I'm nervous. Well, what do I do about that? Those little hunting hand warmer packets, have you seen those? I just keep one in my suit pocket and I keep my hand in there and warm it up, and then when kind of time comes to shake hands, I'm nice and toasty and everyone's happy. Let's see, we talked about sweatiness. Now what about eye contact?
Do it.
Yeah, okay, so your generation is especially terrible with eye contact. Any idea why? Yeah, your phones. You're always looking at your damn phones, right? I shudder to think about the future of the human race because you guys have lost the ability to flirt because you're always on your phone. I suppose you're trying to pick up ladies with text messages, but just the art of flirting has been lost. Maybe that's why population's in decline. I've got a discussion posted about that. Okay, so eye contact. So you want to look people in the eye, but there are also unnerving amounts of eye contact. So it was interesting when I was in business, it was always, you had to look the other guy in the eye, and it was kind of like almost a competition. And if you looked away, it was a sign of weakness. When I went to doctoral school, I'm sitting across from my advisor, and one day he said, "You make an unnerving amount of eye contact." And I said, "Yes." I said it was, the testosterone was like sloshing around the room, and you had to be like burning holes to be able to be seen as not weak. And so then I started working on not doing as much, right? But you've got to be able to make eye contact. If you won't look someone in the eye, what does that say to them? Untrustworthy. Untrustworthy. Your very best liars make great eye contact. Diversify. What do I mean by diversify? You might walk in there and say, "I want to work for a high-tech firm in Dallas, Texas, and that's all I'm going to talk to are high-tech firms from Dallas, Texas." What does that do to your portfolio of employment opportunities? Not very diverse. And what do we know about a good portfolio is diversified. By the way, why should you be trying to talk to people from different industries at this point? Do you think all industries react to the economy in the same way? No. So, like for instance, oil field people, if they were going to be there, if oil prices were headed for the toilet, they're probably not going to be hiring. However, construction companies are always hiring here for some reason. So, diversify. And if you don't know what a company is about, go up and ask. By the way, I want you to maximize your contacts. I want you to talk to just as many people as you can for a couple of reasons. Number one, it maximizes your opportunities. Number two, it gives you a chance to practice interacting with professionals. And number three, it gives you a chance to burn off some of that nervous energy. Do you guys know when you sit down for an exam, that moment before you flip it over and start working on it, what that feels like? And how long does that last? For the first few questions, and then you get into the groove, right? And so the first few people you talk to, you're going to have that nervous energy. So what I want you to do is go talk to people that you're really not interested in. Start with the Marine Corps, unless you're into that sort of thing, which is perfectly fine. But start with the Marine Corps, talk to that guy, and start working on your spiel. You guys know what a spiel is? Okay. Start with a lonely recruiter. So that's your Marine guy. And there will be a lot of, so I used to be embarrassed when we would show up for career fairs when I first started doing it, and we just basically had a little sign, and we had like some pens to hand out. This is when I worked for Halliburton. And there's these people with these banners and all this other kind of crap, and flashing lights and loud noises. And what do you think the recruits were attracted to? The flashing lights and the loud noises. I would encourage you to go ahead and talk to the people who have a crappy table, because they might have great opportunities. They're just not very good at recruiting. So go talk to those people. Now you say, wait a minute, I don't know what the hell I'm going to talk to these people about. Ask them questions about their firm and their industry. What is it that your company does? Oh, wow, that's interesting. Where are your locations at? Oh, do you have any opportunities in Destin, Florida? Because that's where I grew up. Or it's things like that, right? So ask about their firm. Also ask about their industry. So what does the future look like for, let's pick something stupid here. Buggy whips. You guys know what a buggy whip is? Oh yeah, so too much time has passed here. So when my grandfather was a boy, they didn't have cars. They had horse and buggy, right? Kind of like the Amish. And how do you get the horse to, what's the accelerator pedal on a horse and buggy? Yeah, and you're not really hurting the horse. You're just like, letting it know we need to move forward. What do you think happened to the market for buggy whips after the invention of the automobile? Right? Okay, now, you're wanting to ask them about what does the future of your industry look like? Where do you see it going? What are the threats? What are the things that you see that might impact you guys? And what are the opportunities? What's coming out there that you think really might cause your thing to take off? People who are professionals and care about what they do enjoy talking about it. And so get them to talking about their company. They'll think that you're a great conversationalist. And you'll learn something along the way. Plus, you might have an interesting observation. Oh yeah, I was reading the other day in the Wall Street Journal about how whiskey bottles were now being made out of blah. By the way, we're probably going to have the Whiskey Barrel people there. Ozark Stave, I think is the name of the company. They're out of Lebanon. Interesting people. Okay, so ask the questions. A lot of times, students will work the pattern. And every American, for whatever reason, when we walk into a building to do one of these things, what direction do we always turn?
Right.
Yeah, we always turn right. And so what that means is if you are there at the beginning of the day and there is this like pig going through a boa constrictor, this whole group of students heading through there all together because they all came in and turned right, what should you do? Come in and turn left. Run the circuit backward. And you'll be meeting a lot of people who are standing there twiddling their thumbs because they're waiting for this group of people. I wish they would do this with Halloween in my neighborhood, but instead we just get everybody together in a big group. And then, so you're like handing out candy like crazy for 2.5 minutes, and then you're done, right? So go the other way. Go against the grain. Any questions? Okay, I'm going to be there. Don't know how much of the time I'll be there, but I will be there. And if I see you standing on the wall, I'm going to peel you off because nobody is hiring people who stand on the wall, right? And if you're standing on the wall, you'd be much better off going to talk to employers that you don't know about or that you don't want to work for than you would be standing on the wall. Does that make sense? Okay, my final piece of advice regarding career fairs is this. First thing you do when you get there, go to the bathroom. Go to the bathroom, empty your bladder, reduce that pressure on your mind, make sure your pants are zipped. Wash your hands, dry your hands well. I was interviewing with the president of Oklahoma State University, and I thought we had a great interview. He and I both went to the same doctoral school. And when I got up to leave, I realized my pants were unzipped. Do you think I got an offer from them? No. I don't even know if he knew my pants. I ran into him years later and asked him, I said, did you realize my pants were unzipped? And he said, no. He may have just been being kind. Okay, any questions? Okay, so we're on chapter 14 now. There are 3 big questions in finance. There's what we call the capital budgeting question, and that question is, what assets should we buy for the firm? And we're going to answer that question by saying that we should buy everything that has a positive net present value. Hopefully you guys have survived enough finance to know what net present value is. Okay, so that's question number 1. Question number 2 is, how are we going to pay for those new assets that we're going to buy? Are we going to issue debt? Are we going to issue equity? And we call that the capital structure question. So that's question number 2, and that's the one that chapter 14 starts talking about. And then the final question is, how do we manage the short-term cash flows of the firm? In accounting and finance, what is short-term?
Less than a year.
Yeah, less than a year. So long-term would be the rest of that. The stuff we're talking about then is what's going to go on in the next year. What do we call assets that we think will turn into cash within the next year? Current assets. And what do we think are liabilities that we're going to have to pay within the next year? Current liabilities. And what do we call the difference between current assets and current liabilities?
Current ratio. That's not.
Well, it's
Yeah.
current assets over current liabilities. What is current assets minus current liabilities?
Is that net working capital?
It's net working capital. Thank you. I've got to give you a, there you go. Very good. He's wearing his Caesar's Palace shirt today. He was feeling lucky.
Hope so.
What's that?
Hope so.
Yeah. Do you realize that it's not Caesar apostrophe S, but it's Caesar with an S and no apostrophe? And the idea was that this is where any average Joe can go and be a Caesar. So everyone that there is, in theory, a Caesar. Now, is that useful information to you? I don't know. But it is one thing that I did learn from YouTube, as well as how to change a brake light on a 2013 Nissan Altima. Back to the story. Okay, so net working capital. So we call that last question working capital management. Working capital management. Now, out of those three questions, which one do you think is the most important?
Net working capital.
Yeah, the working capital management question. Why? You got the right one, but you don't know why. So what happens if you don't have enough cash in your checking account to pay your bills?
Bankruptcy or sell
Yeah.
long-term assets.
Yeah, you got to do something, right? But you know that if you can't get a hold of the cash, if you can't make your debt payments, for example, you're going to wind up in bankruptcy. There is no long term if we don't take care of the short term. And that's why the third question is the most important. Because if we don't take care of that short term, we're bankrupt and we don't have to worry about the long term. The first two questions are about the long term because we're talking about what assets we're going to buy and how we're going to fund them with debt and equity. By the way, capital structure, when we use that term, you can also think of capital structure being defined as the mix of debt and equity that we use to finance the firm's assets. Capital structure is the mix of debt and equity that we use to finance the firm's assets. Hopefully you guys recognize this formula right here. Do you guys know what this is? What's the A stand for?
Assets.
Yeah, what's the L stand for?
Liabilities.
And what's OE? Owner's equity. And we have a name for this equation. Do you recall? I'll give you a hint. It's that accounting thing.
You just call it basic accounting.
It's the balance sheet equation. It's the balance sheet equation. Okay, now you may see it, and this is looking at book values. But in finance, what do we prefer to talk about? Market values or book values?
Market.
Yeah, market values. And so you may see these ideas expressed in this way, that the market value of the firm is equal to the market value of the debt plus the market value of the equity. But you can see that it basically follows the same form. You may also see it written this way. The market value of the firm is equal to the market value of, what do you think B stands for? Come on, follow the bouncing ball. Liabilities, debt, bonds. Very good, thank you. And someone else could probably get what S stands for now. Stock. And so these are market value equivalents to this idea. And so we're going to be looking at the value of the firm, and we're going to picture it as a pie. And that value is the combination of the market value of the stock and the market value of the bonds. Now let's talk about the nature of the claims for stocks and bonds. Debt is a fixed claim. For example, my mortgage every month is $1,600. $1,600 every month. Now, in the summertime, I pick up extra teaching, and so I have extra money. Do you think that the bank sends me a larger bill because I have a higher income? No, it's a fixed claim. So when my income's going up, that seems really good. That my house price, my house cost has stayed down here, but now this extra money is flowing to me. I have a residual claim. So they have a fixed claim, I have a residual claim, I get the leftovers. However, in bad times, what would happen if I lost my job here at the university? My cash flow drops to zero. Does the bank say, yeah, don't worry about it. Sorry to hear that, pal, it's all good. No, it's a fixed claim. They expect me to pay that bill, and if I don't, what are they gonna do?
Take the house.
They're gonna take the house. And in business, if we don't pay our bond, the coupon payments, and then the face values as promised, what happens? We get forced into bankruptcy, right? Okay, so what does that mean? It means that if we are going to, by the way, the goal of financial management, what's the goal of financial management? Maximize shareholder wealth. And so you might look at this thing and say, well, wait a minute, I'm going to figure out how to maximize S there. But in fact, we start with thinking about the value of the firm. And we say, first, let's try to maximize the value of the firm. Because it's easier to think about, easier to do. Let's maximize the value of the firm. And that is exactly the same thing as maximizing shareholder wealth, because that debt is a fixed claim. So anything that's left over goes to the shareholders. So if I borrow $100 million and I grow the firm into an $800 million firm from a $500 million firm, that extra $300 million, who does it go to? The shareholders. The debt holders get stuck with the same amount they would have gotten regardless. Does that make sense? Okay. Now, knowing all that, we should be saying, well, wait a minute. We know that we're supposed to take on all these positive NPV projects to try to maximize the value of the firm and therefore maximize shareholder wealth. But is there something we can do with the capital structure that would maximize the value of the firm? Because we know if we did do something that maximized the value of the firm, all the gains would flow to who? The shareholders. It's going to flow to the shareholders, and that's the goal of financial management. And so it's really intriguing to ask, is there anything that we can do with our capital structure to maximize the value of the firm and therefore maximize shareholder wealth? So we've already talked about the first one. And so the big question here is, what is the debt to equity ratio that maximizes shareholder value? And once again, the only reason that the capital structure would benefit shareholders is if it increases the overall value of the firm. So I've pretty much covered everything on that slide. So let's talk about an example. We have a firm here that currently has $20,000 in assets and $0 in debt. As a result, we know that the equity is equal to 20,000. Because 20,000 is equal to 0 plus the owner's equity. It has to be 20,000. Let's see, the debt to equity ratio is 0. How did I calculate the 0 debt to equity ratio there?
No debt.
Yeah, there's no debt. 0 divided by anything is 0, except for 0 divided by 0. Don't do that. Mathematicians get torqued up when you do that. So we know the debt to equity ratio is 0. The interest rate, not applicable because we don't have any money borrowed. We have 400 shares outstanding and the share price is $50. Now, if you take 50 times 400, what do you get? 20,000, and it better be, because that's what we were saying up here earlier, is that we had 20,000 in equity. Okay, so here is what we're proposing. We're going to go out and we're going to issue $8,000 in debt. And we're going to use that $8,000 in debt to buy back stock. So we're going to be levering up the capital structure of the firm. How many shares can I buy with $8,000? How would I calculate that? Yeah, 8,000 divided by 50. And guys, feel free to always have your calculator out during class because, you know, when I ask you these questions, I know sadly you guys can't do this math in your head. Mr. Bardwatch, can you do this math in your head? Just a little bit. Mr. Lee told me he had to use a calculator in grade school, so he can't do this. And I'll bet none of the Americans can either. 8,000 divided by 50 is 160. It's 160. Now, we started out with 400 shares. We've repurchased 160. 400 minus 160 is 240. And so now we have 240 shares outstanding at a share price of $50 each. And we can check our work here. If we take 240 times 50, that gives us 12,000, which is what would be left if we bought back $8,000 worth of the original $20,000 worth of stock. So our numbers all check out. Have I blown your mind at all yet? Okay, good. So let's talk about the earnings per share and the ROE under the current structure. And we have three scenarios here. We have recession, expected, and expansion. I want you to take your pencil or pen and mark out expected and write the word normal above it. I want you to scratch that out and write normal above it. And here's why. If we had percentages on these things, probabilities for each one of these, we could come up with the expected value for EPS, for ROA, for all of those things. And so to use the term expected to describe one of the three states of the economy is kind of nutty. So that's why I want you to cross that out and write normal. So the idea is this. In a recession, our firm has EBIT of 1,000. What does EBIT stand for? Earnings before interest and taxes, right? In the normal situation, we have 2,000, and in an expansion, we have 3,000 EBIT. What can we say about the cyclicality of this firm? Is it pro-cyclical or counter-cyclical? Do you guys know about the business cycle? When the economy is growing, we're on the upward side of the business cycle. When the economy is shrinking, we're on the downward side of the business cycle. When does this firm do its best?
The economy's good.
Yeah, when the economy's good. So we would call this firm pro-cyclical. If the EBIT was 3,000 in a recession and 1,000 in an expansion, we would say it was counter-cyclical. So what makes firms be pro-cyclical or counter-cyclical? It comes down to the kind of goods or services they provide. So for example, if you think of luxury goods sell a lot during good times, but a lot less during bad times. What about cheap alcohol?
Goes up in the bad times.
Yeah, it goes up in the bad times and goes down in the good times. Does that make sense? And so that business would be counter-cyclical. This one, though, appears to be cyclical. In the current structure, we have zero interest because we haven't borrowed any money. And so all of that EBIT flows straight to net income. By the way, we are assuming no taxes here. I don't think I've said that yet, but go ahead and write on there, we assume no taxes. And we will be assuming no taxes right up until I tell you, now we're going to consider taxes. Okay, so all that's going to flow straight through to net income, and all we have to do to get the earnings per share is to divide by that original 400 shares. So 1,000 divided by 400 gives us $2.50 EPS during a recession, gives us $5 during normal time because we would take 2,000 divided by 400 shares, and it gives us $7.50 during an expansion because we're taking 3,000 divided by 400 shares. So that's how we get the earnings per share. Now, the return on the assets and the return on the equity at this point are identical. Why?
Because there's no debt.
Yeah, there's no debt, and so the total assets equals the total equity. So ROI, let's see, ROA is net income divided by total assets. ROE is net income over total equity. Well, at this point, total equity and total assets are exactly the same thing, and so therefore ROA is going to be exactly equal to ROE. And so all we have to do is take that EPS and divide by that 20,000. We know that the value of the assets is 20,000 because in the beginning there was 20,000 equity and no debt. So the assets had to be worth 20,000. So if we take the EPS divided by 20,000, it gives us an ROA and an ROE of 5% in recession. $5 divided by that 20,000 gives us, is it 20? $5 divided by 20,000. Oh, good. Sorry, it's not by 20,000. So what we should be taking is the net income divided by 20,000. So 1,000 divided by 20,000 gives us 5%. 2,000 divided by 20,000 gives us 10%, and 3,000 divided by 20,000 gives us 15%. Now there's another way we can do this. We can take, to get the ROE, all we have to do is take the earnings per share and divide by the price per share. All we have to do is take the earnings per share, divide by the price per share. Do you remember what the share price is?
50.
Yeah, it's 50. And so we're going to take 2.5 divided by 50, and that gives us 5% ROE. We know ROE and ROA are going to be the same here. And then we have $5 divided by 50 gives us 10% for ROE for the normal. And then in expansions, 750 divided by 50 is 15%. And so you can see how all these numbers come to be. Any questions so far? The math is really simple when you don't have leverage. It gets considerably more difficult when you add leverage here. So first of all, we know that we know the EBIT stays the same. The business risk has not changed any. The business we're engaging in has not changed any. The assets that we own have not changed any. So the EBIT is going to be the same as it was for the unlevered firm. But we borrowed $8,000 at 8% interest. I don't know if I told you the percentage of interest, but it was 8%. What is 8% of 8,000?
640.
640. And so we are going to have to subtract that 640 in interest to get to our net income. And so when we do, our net income is 360 in a recession, 1,360 in the normal state, and 2,360 in an expansion. Now let's talk about, we haven't defined what these things are. We have a technical definition for recession. It is 2 consecutive quarters of negative GDP growth. What does GDP stand for? Gross domestic product. And so if we have 2 quarters in a row where it shrinks, then we are technically in a recession. So that's how we determine recession. Expected, or the normal, kind of what we expect. It's now at this point in our country's evolution, it's what, 2 to 3% per year, something like that is about what we would expect. Do we have higher than that sometimes? Yes. Do we have lower than that sometimes? Yes. Is the normal different from country to country? What's GDP growth like in India? You don't know? Not good enough. Well, we all feel like that about our own countries, right? Not good enough. But is it more than the U.S.? I think so. I think you're pushing around 5%. I don't know. I really don't follow India that closely, but typically, developing economies grow faster than developed economies. Is India a developing economy? We hope it's developing, right? Yeah, and so China keeps trying to say they're doing 5%. I think they're lying. But 10, 15 years ago, they were double-digit GDP growth. And so expected is different for every, or normal is different for every country. And then expansion. That's when things are growing faster than we would normally expect them to. So we don't have a really great scientific definition of that one or of normal. In fact, the definition of normal changes with time. I'll give you an example. The year is 1989. I am sitting in an economics class at the University of Arkansas, and the professor assures us that the natural rate of unemployment in the United States is 6.15%. 6.15%. In other words, if the unemployment rate is at 6.15%, that means we are at technically full employment. What's the unemployment rate today?
It's like 2 or 3.
I think it's a little higher. I think 4. I think we're looking at around 4, and it's been around 4 for quite a while. So I think if we talked about what the natural rate of unemployment was today, we'd probably talk more like 4%. And so my point to you is that not only do these things change across countries, they also change through time. For example, China used to expect 10% GDP growth, and now they would be thrilled to get 5% GDP growth. Okay, so now that we have the net income, we can figure out the earnings per share. The trick is we have to now remember that we have 240 shares. We used to have 400. So now when I figure out EPS, I'm going to be taking the net income and dividing by 240. And so that gives me $1.50 earnings per share in recession, $5.67 in normal times, and $9.83 in expansion. Now let's take a quick look back and keep these numbers in your mind. How do they compare? Let's start looking at recession. Which would you rather have, the levered firm or the unlevered firm? Yeah, the unlevered. But when we get to the normal times, which would you rather have? The levered firm. And when you get into expansion, for sure you would rather have the levered firm. Now, we have to make another adjustment here. Before, because our assets were exactly equal to the equity, ROA and ROE were exactly the same thing. That's no longer true because now we have debt in the capital structure. So how am I going to find ROA? Well, the firm is still worth $20,000. So if I take that 300, that's the assets. If I take that 360 divided by 20,000, that gives me a return on equity of 1.8%. How can I figure out the return on equity? Well, how much is the equity worth? 240 times 50 would give me 12,000. If I take 360 divided by 12,000, that gives me 3% return on equity. Now notice the return on equity is greater than the return on assets. And that is because ROE is equal to ROA times the equity multiplier, which is 1 plus the debt to equity ratio. And so if debt goes up, so let's start with the zero debt case. What's the equity multiplier in the zero debt case?
0.
Well, the debt to equity ratio is 0. 1 plus 0 would be 1. So the equity multiplier in the no debt case is 1. So that's why ROA is equal to ROE. However, if I start to sprinkle in the least bit of debt, then ROE starts to climb away from ROA. And at first it looks really attractive to just keep piling on the debt because it really jacks up that ROE. We're going to learn, hopefully today, that the reason this happens though is because now the equity of the firm is riskier. In fact, I can demonstrate that to you right now. Take a look at the ROE here. What's the range? It goes from 3% up to 19.7%. Let's take a look at what happened before we started adding in the leverage. we only ranged from 5 to 15%, which is the bigger range. Levered or unlevered? That's got to be levered. Therefore, which one is riskier? The highs are higher, the lows are lower. We know that that levered firm has to be riskier. And that's why that ROE has to be greater. Now, which one of these would we prefer? Well, if we were expecting a recession, we would prefer the unlevered firm. But how often do you think we put a greater probability on recession than on these other two states of the economy?
Much less.
Yeah, so it's far fewer amount of time. Now, right now, if you look at the headlines in the newspapers, what do they all say is just around the corner?
Recession.
A recession. And how long have they been saying that?
8 years.
Yeah, well, on and off for quite some time, right? Especially since Trump took over in January, they're all like, oh, we're going to have a recession, we're going to have a recession. Has it happened? No. Will it eventually happen? Yes. Oh yeah, every developed economy eventually has recessions. It's so interesting to see my Chinese students because they've never lived, in their professional lives, they've never lived through a recession. And I explained to them, eventually your economy is going to go through a time where it shrinks. And they're like, and I'm like, guys, that's just normal for the rest of the world. It's just something new to you. Okay, so right now though, if you look at the probabilities that people are putting on recession, I don't even know that you could make the case then that you should go with the unlevered versus the levered. And here's why. In order to figure out the expected ROE, what would we do? We would take the probability of a recession, multiply it by 3.0%, plus the probability chance of normal times, multiplied by 11.3%, and then plus the probability of the expansion multiplied by 19.7%. And we would do that for both the levered and the unlevered. And whichever one had the higher expected return, we would go with. Now, which one has the higher expected return totally depends on those probabilities. And so if you were really sure that you were going to have a recession, you wouldn't borrow the money. You wouldn't buy back the stock. By the way, over the course of history, which one of these things do you think has the biggest probability of happening?
Somewhere between expected and expansion.
Well, I would say that expected, the normal, is the one that happens the most, right? And by the way, expansion just means expanding more than the normal rate. Because normal is expansion, you're right. So it's definitely positive GDP is our normal, positive GDP growth is our normal expectation. Okay, and so we cannot, with the numbers that we're given here, make a definitive decision on which one we should go with. Do people making decisions in the real economy have the kind of information that we're talking about that we would need to figure this out? Every single thing that they have to work with is a swag. Have I told you guys about swags? What does swag stand for?
Scientific wild-ass guess.
It's a scientific wild-ass guess, right? And in fact, this net income, or this EBIT number for recession expected and expansion, that's a swag. And the probabilities of the different states of the economy, those are swags. And if you ask 10 different economists to give you the probability for those three things, the first thing they would ask you for is a definition of each of those. And then the second thing, even if they all had the same definition, they would give you different numbers. Questions so far? Okay. So let's look at this graphically. The solid red line there is no debt. And I want to point something out. This scale on the bottom is deceiving because most of you in your minds assume that that starts at x equals 0. X, the horizontal axis, you expect it to start at 0. It doesn't. It starts at 500. So make a note of that so you don't get freaked out. Because if the EBIT, that's what's on the horizontal axis, if the EBIT were equal to 0, what would the EPS be for an unlevered firm? You got 0 EBIT minus 0 interest. You're going to get 0 in net income. 0 net income divided by the number of shares is going to be 0, right? But here we see it's something a little less than $2, which tells us that that axis doesn't go all the way to 0. So that's the first thing I want to point out here. The vertical axis is EPS, the horizontal axis is EBIT. Once again, we are assuming no taxes. What happens though when we throw debt into the picture? Well, we mentioned earlier that in good times and great times that we actually do better with debt in the capital structure. And you can see that the earnings per share is higher in the firm with debt than in the one without debt. However, there is a point at which both of these firms have exactly the same EPS. And so that's the break-even point. At that point, the EPS and the ROE are identical between the two firms. So you would be indifferent. Do you guys know what indifferent means? Yeah, we don't care. We don't care. You could choose, it doesn't matter. We could go either way. However, when you get below the break-even point, what happens to the EPS of the firm with debt? Yeah, it falls below the EPS of the unlevered firm. And it all boils down to this. We have substituted some equity, we've used debt, which is a fixed claim. And so that $640 in interest, we're going to have to pay that regardless of whether the economy's in an expansion, normal, or recession. And so that's why when we are in recession, we see we are doing worse here, having the debt in our capital structure because we've got that fixed amount of interest that we have to pay. So you can think of this area between no debt and debt to the right of the break-even point as being the advantage to debt. So you see that kind of triangle area there? That is the advantage to debt. However, on the back side, we can see on the left-hand side of the break-even point that that triangle now is the disadvantage to debt. So that's how much worse off you are because of having debt. Questions? By the way, how would you describe the slope of these lines? First of all, let's get the idea of slope. How do you define slope for a line? Rise over run is what my grandfather would say. Change in y over change in x would be the mathematical way. Which one of these lines has a steeper slope?
Debt.
Yeah, the one with debt in it. And in fact, what we see is, what that means is that as EBIT increases, EPS increases faster at the levered firm than at the unlevered firm. That slope is a double-edged sword. When EBIT is going up, we're happy because it's magnifying that increase in EBIT to shine through to our EPS. But what happens when we're going down in EBIT? What does that steep slope do? It magnifies that drop, right? And so now we have, so it's kind of like we were seeing over here. This is a magnifying effect. So now we are on to the M and N model. How many of you actually read the chapter? What does M and M stand for? It's not a candy.
Modigliani.
Yeah, okay, so my first semester in doctoral school, my office mate was an Italian opera singer, now a great finance professor, but he was an interesting guy. So we're sitting there and we're both taking this class and we're both learning about these people. And I pronounced this guy's name Modigliani. And he says, no. He says, it's Modigliani. I said, Modigliani? He said, no, Modigliani. Now, I can't hear the difference between those. The only difference I could see is this, right? I'm not going to criticize you one way or the other if you call him Modigliani, or if you're actually Italian and you know how to say that. But that's his name, and his first name is Francisco. The other guy's name is Miller, and they came up with this idea. And in fact, let's roll back. This idea first gets tossed out in 1958. For you guys that didn't realize it, finance is a very young discipline. Finance is the bastard offspring of economics and accounting. And the fathers of our field, and they were all men, tended to be economists by training because they actually invented the field of finance. Prior to 1958, finance was a normative kind of thing. Normative meaning that people had these rules of thumb, and they would tell you what you should do. And some of the rules of thumb worked out, but some of them were total crap. And it was only once Modigliani and Miller start applying some science to this whole thing that we see finance turning from this is what you should and shouldn't do to here's a scientific explanation of what's actually happening. So, one of the things you'll notice, and I told you these guys are both economists, one of the things that you'll notice about any economic argument is it always starts with a bunch of assumptions. And they'll say things like, assume a one good economy that lasts precisely for one period with no taxes, no transaction costs, and they'll make this bunch of assumptions. And those assumptions make absolutely no damn sense whatsoever. Because in the real world, do we have taxes? Yes. Do we have transactions costs? Yes. Does the economy go on for more than one period? We hope, right? And so there are all these assumptions that they make. And the reason that they make these assumptions is so we can dig down and get to the core of the matter. And then once we figure out the core of the matter, we can go back and start saying, well, what happens when I relax this assumption? What happens when I relax that assumption? And that teaches us even more. Now, here's my favorite economist joke based on this whole discussion of their assumptions. 4 economists are shipwrecked on a desert island, and they have a can of beans, and that's all they have. And they're all staring at the case of canned beans. They're all staring at it. And the first economist says, does anybody have any ideas? And they all thinking very, very intensely on this. And the second one raises his hand and says, assume a can opener. Okay, first of all, economists aren't very funny. But secondly, it's one of those assumptions that it's not correct, and it wasn't very helpful at the time, but of course that's the first thing economists go to is coming up with these assumptions. So what kind of assumptions did Miller and Modigliani make about this thing? The first thing is they said that all investors, whether they be the stock investors or the bond investors, have homogeneous expectations. Homogeneous expectations. Let's talk about that first word. What does homogeneous mean? Or you might hear it called homogeneous. Yeah, it's all the same, right? Homogeneous. It's all the same. In fact, we talk about homogenized milk. They basically have taken the butterfat and the milk and ran it through and made it into where the first glass of milk is the same as the last glass of milk. That's homogeneous. When I was a kid, we used to actually get milk from cows, and there would be milk, and then on the top of that would be cream, and then there would be a couple of hairs floating in the top. That's how fresh it was. Isn't that disgusting? Okay, back to the story. So we say homogeneous expectations. Do you think that's a reasonable assumption? I don't think so. First of all, you get any 2 people in a room and you ask them, what probability would you put on a recession? Even if you had 2 highly educated economists, do you think they would give you the same number? No. I'll give you an even more down-to-earth example than this. Probably somewhere in the S&P 500 index funds that I own some shares of Tesla. Do you think I have the same expectations for Tesla that the Tesla fanboys do? No. Or do you think I have the same expectations for Tesla as the people who think Elon Musk is a Nazi? No. And so we've got, what, 3 groups of expectations here at least. And so we know this first assumption is not correct, but once again, it's one of the simplifying assumptions that helps us get to the core of the matter. Second, we talk about homogeneous business risk classes. So you guys have probably, hopefully, you've heard of beta and the security market line. And what we're saying here is that within an industry, every firm in that industry basically has the same beta, although beta hadn't been invented when this beta comes around, probably 1964. So we're still 6 years before beta shows up. And so basically what they were saying is that everybody knows the risk of a given business because of the industry, and there's homogeneity to that. So if we've got one hotel here, it's just as risky as another hotel. Now, is that necessarily true? No. I'm going to tell you about 2 car companies. What about Ford and BMW? Do you think Ford and BMW have identical business risk? No, why not? First of all, what kind of vehicle is BMW compared to Ford? Luxury. So is it going to be more pro-cyclical than Ford or less? Yeah, it's going to be more pro-cyclical than Ford. So there's your first problem. The second is the product mix. Ford makes most of their money on pickup trucks and SUVs. BMW, not so much, especially the pickup truck part. I've never seen a BMW pickup truck. So even when you get down to things like that, we can immediately say that this is not correct. However, it's one more of these simplifying assumptions. And then we make the assumption of perpetual cash flows. What does that mean? It means the business goes on and on and on and on. In theory, how long can a corporation live? Forever, right? In theory, a corporation can go on forever. It's got what's called perpetual succession. And so from that perspective, perpetual cash flows might not be a bad assumption, although we know that in reality it's probably not correct. Okay, so that's about the business. Now let's talk about capital markets. Capital markets are where we go out to sell shares, where we go out to borrow money. And the first thing that we say there is that there's perfect competition in the capital markets. Do you think there are any markets where we have perfect competition?
Agriculture. Farming.
I know what you're talking about. I would say it's closer. When you get to where you've got a bunch of small producers selling in a commodity market, that's getting really close. But when we're talking about these financial, let's say banks, we know that we don't have a bunch of little banks. We've got a bunch of little banks, but the big players, the ones who are basically doing these bond offerings, investment bankers, that's more limited. So the assumption of perfect competition is more limited there. Firms and investors can borrow and lend at the same rate. Who do you think can borrow for less? Ford Motor Company or you?
Ford.
Everybody assumes that Ford can, but the truth is you can. Would you like to know how? No curiosity whatsoever? Okay, Mr. Birdwatch would like to know. Here's how. Have you ever heard of buying stock on margin? Yeah. So if you buy stock on margin, what they're doing is they're using the stock in your account as collateral to loan you money to buy more stock. And if you get down to a certain level, and if stock prices start to fall and your account balance gets down to a certain level, you will receive a call. It's called a margin call. They'll probably send you an email now. But back in the day, it was a telephone call. And they're like, hey, Mr. Roy, your balance in your account has fallen below the maintenance level, so you're going to have to send us some money. That's called a margin call. At that point, Mr. Roy's like, oh, bummer, man. I don't have any money and it's 2 weeks to payday. They're like, don't worry. What are they going to do?
Liquidate your shares.
Yeah, they're going to sell enough of his shares to get him down to where he's no longer in violation of that maintenance level. Now, as long as the share values don't plummet to zero in an instant, they can stay out in front of this problem, which basically means loaning money to you is, in essence, risk-free. If it's not totally risk-free, it's getting damn close to it. And so the margin borrowing that you do is actually at a cheaper rate than Ford can borrow money. And so in this case, the assumption actually falls more in the favor of the investors than you might expect. Next, we have equal access to all relevant information. Do you think that's the case? Now, let's talk about equal access to all relative information. What they're really saying here is no information asymmetry. I'm trying to remember how to spell asymmetry. There we go. No information asymmetry. What's information asymmetry? It's where different groups involved in a transaction have different amounts of information. For example, I know exactly what will be on exam 1. Do you? I should hope not. If you do, we need to have a talk, right? So, we do not have equal access to all relevant information. Why do you think we have insider trading laws?
Insiders would have the advantage.
Yeah, insiders. So we don't have equal access to all relevant information. The insiders have more of it. If this assumption were correct, would we need insider trading laws?
No.
No. Okay. No transaction costs. No. Some of you say, wait a minute. In my Robinhood account, by the way, how many of you have Robinhood accounts? Mr. Bardwaj, we're going to have a talk. Hi. Robinhood steals from the rich and gives to the poor. Here's what you don't understand. In this story, you're the rich, right? The Robinhood shareholders are the poor. They're taking your money. Now, how are they taking your money? You say, wait a minute, I'm not paying any commissions. What they do is they put you into these dark pools at places like Cypress Capital, I think is one of them, where basically you are forced to trade with these huge bid-ask spreads. You guys know what the bid-ask spread is? Yeah, so they throw you into these situations where the bid-ask spread is wide. That bid-ask spread is a transaction cost, and they get paid for the order flow. They get paid for routing you poor hapless souls into these situations so you can be plucked. Okay, so even if you have a Robinhood account or even my Charles Schwab account, in theory it has no transactions cost, but every time I transact, there are bid-ask spreads. And then we have no taxes. Is that a good assumption? No. In fact, we say there are two things in this life that are certain. What are they? Death and taxes, right? You're saying, well, wait a minute. We know that whatever this M&M model comes up with is going to be totally meaningless because these assumptions don't hold. And that's true. But when we get to that nut of the problem and then we start working backwards, relaxing these things, we can start to see how they all impact it and whether they change the basic conclusion that we reached using these assumptions. Okay, so let's take a look here. We have an unlevered firm, and we have, once again, recession expected and expansion. I want you to cross out expected once again and write normal. And we see we've got our earnings. In fact, I believe this is exactly the same example, only divided. We've got I think it's off by a factor of 10. You know, everything's divided by 10, basically. And we've got that same ROE that we saw before with the 3%, 11.3%, and 19.7% after we account for the interest. So we're going to buy 40 shares of this $50 stock. So we were buying 400, now it's 40, using $800 in margin. So we could get the same ROE as if we bought into a levered firm. So what's the idea here? This is the idea of homemade leverage. If there's an unlevered firm, but I would prefer to have the stock of a levered firm, I can simulate that in my account. How can I do that? I can borrow money in my brokerage account and use it to buy shares. So in our example earlier, we had $20,000 of assets. We borrowed $8,000 to buy back stock, and so now we've got $12,000 in equity and $8,000 in debt. Well, here we're going to borrow $800, and we are buying 40 shares of $50 stock using $800 in margin. So we're going to have $1,200 in equity, $800 in debt. Do you see that those ratios are exactly the same? The debt to equity ratio would be exactly the same as it was for the levered firm that we talked about earlier. And so we could actually achieve exactly that same return on equity in our brokerage account that the company can on their balance sheet. Does that make sense? So, what does that mean? It means the company can't do anything for you that you couldn't do for yourself. In fact, that means that the company cannot create value through capital structure manipulation that you couldn't create for yourself in your own brokerage account. In fact, it's even a little worse than that, because remember, I told you who can borrow more cheaply? You can, right? You can. They're borrowing at 8%. If you went out to borrow on margin today, probably 2% is what you're looking at, maybe 3%. And so you could actually come out better by doing this homemade leverage than by having the firm do the leverage on their side. So this is our first piece of evidence that you cannot create, under the assumptions we have so far, you cannot create additional value simply by levering up the firm. Let me say that one more time. Under our current assumptions, you cannot create additional value simply by changing the capital structure of the firm. Because any leverage you do in the firm can be done by someone in their own account. If you decide to lever up the firm and they didn't want to have a levered position in your firm, what could they do? They could buy both the stock and the debt, and then they would have identically the same cash flows as if they owned the unlevered firm. So we can do homemade leverage, and we can homemade undo leverage. Note that our personal debt to equity ratio here, 800 over 1200, is exactly the same as the debt to equity ratio of the firm at 8,000 over 2,000. So here's our unleveraged example. If we went out, so we've got the EPS of the levered firm, which we want to undo, and so the earnings for 24 shares there would be $36, and we could go out and invest that $800 at 8%. This is $800 that we didn't spend. So we spent $1,200 buying shares, and we put that other $800, we loaned it out at 8%. Remember, one of the assumptions is that you can borrow and lend at the same rate, and that investors and the firms can borrow and lend at the same rate. So it's all the same rate. And so we are pulling in $64 with our interest there on that $800. 36 plus 64 gives us net profits of $100. And we divide by the 2,000 value of the portfolio. That gives us a 5% ROE. If we do in the normal, we would have 136 plus 64 gives us 200 in net profits. 200 divided by the 2000 value of your portfolio gives you 10%. And then expansion, we see the same thing where we can basically get back to the same figures as the unlevered firm. And so I can either take a levered firm and turn it, or an unlevered firm and turn it into a levered firm in my portfolio, or I can take a levered firm and turn it into an unlevered firm in my portfolio. So anything that the firm can do, I can undo. Anything the firm can do, I can replicate. And so this brings us to the concept of capital structure irrelevance. What does irrelevance mean?
Doesn't matter.
Doesn't matter. The capital structure does not matter for the value of the firm. The firm value is the same regardless of the capital structure. Now, keep in mind that is given all those assumptions that we started with. Once we start relaxing those assumptions, we're going to see that the capital structure can matter for firm value. But we're going to see that there's some limits to how much we can do with that. But that's getting on further in, even I think into chapter 15. Any questions? What does M&M stand for? Exactly. Modigliani and Miller. And what is Modigliani and Miller's Proposition 1? Which, let's see if we've actually got it on the slide here. The value of the levered firm is identical to the value of the unlevered firm. That's Modigliani and Miller Proposition number 1. Now keep in mind that is only true because of all those assumptions that we've made. And so for right now, that's, if you remember nothing else today from this lecture, it's that the value of the unlevered firm and the value of the levered firm are identical under Modigliani and Miller Proposition 1. Once we start relaxing the assumptions of Proposition 1, then we will see that is no longer true. Are there any questions?